Hi, welcome to my 30 Days of Dow recap of days 1 through 15. If you don't know what I'm talking about, head on over to Instagram at dz.money to see my Dow posts. So, we've been talking about so many concepts such as market cap, earnings per share, price to earnings, dividends, percentage held by institutions, beta, revenue, volume, current assets, current liabilities, PEG ratio, ROE, ROA, ROI, and historical volatility. There are so many financial ratios and terms that it may seem hard to keep it all together. While all are helpful to know as you are learning about investing, there are 5 that are really important that I'd like to recap. Market cap is the number of stocks outstanding times the price. If there are 10 million outstanding shares and the price is $50, then the market cap is $500 million. This would be a really small company though. A small cap company is one that has between $300 million and $2 billion. A company like iRobot would fit under a small cap stock. A mid cap stock is $2 billion to $10 billion, and Planet Fitness would be considered a mid cap stock. A large cap stock is one above $10 billion. There are many we've been talking about the last few weeks, but Apple is one of the biggest. Typically, you don't want to hold stocks of only one size. So you want to pay attention to what stocks you are interested in and what market cap they have. Smaller cap companies are riskier as they have not been around for a while, and one bad move might be enough to hurt the company forever. But smaller cap stocks have more upside. Next up, we have earnings per share. Earnings per share, or EPS, is net income minus preferred dividends divided by the number of outstanding shares. For Apple, their net income minus preferred dividends in 2018 was about $60 billion. The number of shares of stock they have are about $5 billion. So earnings per share in 2018 was $12.01 per share. EPS is important because this is quite literally what you earn as a stockholder. You want to compare EPS to what the EPS was in the prior year to see if the company is earning more than the last year. Also, you want to compare EPS to competitors. Looking here, the EPS has grown in each of the last 3 years and is significantly better than one of their competitors, Dell. Next up, we have revenue. Revenue shows how much money a company is bringing in each quarter from selling their products. If revenue is rising, this means that people are either buying more product, which is a great thing, or that the company raised prices on their products. If the former happens, this is an indication that the company is growing. This is a great sign when looking at whether to buy a stock. For example, Apple's revenue in 2017 was $229 billion, and in 2018 it was $265 billion. They have continued to make more money each year while cutting the price of their products, which is a good sign for future growth. Now moving on to price to earnings. This is the current price of one share of stock divided by EPS. Since the current stock price is in the numerator, a PE greater than 1 indicates that the market is valuing the company more than the earnings. This is normal because the market takes into account future earnings. Price to earnings is also relative. How does PE compare to other competitors? Some industries have a high PE, like healthcare and tech, and others have a low one, like financial companies. For ExxonMobil, they have a PE of about 17. 2 of ExxonMobil's competitors that are also in the oil and gas exploration industry are Chevron and Occidental. Chevron has a PE of about 16 and Occidental has a PE of about 9, while the industry PE is 16.69. So ExxonMobil and Chevron are both right at the industry average. This means the stocks aren't cheap nor expensive. Occidental, on the other hand, may look undervalued. Since Occidental is a similar company, you need to dive deeper. What is the reason their PE is lower? In terms of earnings, all 3 companies returned about the same amount of earnings, $4 to $5, and pay a nice dividend. So really, it is just the price of Occidental that is much lower at $45 a share, whereas Exxon is $72 a share and Chevron is about $124 a share. Looking a bit more into other numbers, Occidental's profit margin was at 18% compared to 6% for Exxon and 9% for Chevron. Earnings growth for all 3 companies are negative, but Occidental's earnings growth is less negative at negative 2.6%. In terms of revenue growth, Exxon has revenue up 9%, Chevron 3.8%, and Occidental 25%. Altogether, it appears Occidental's PE is a bit lower than other competitors, and other ratios indicate that they might be a more favorable buy. Lastly, we have beta. Beta is a statistical term that explains how much a stock price moves compared to the S&P 500. If beta equals 1, it moves 1-to-1 with the S&P 500. Let's take Boeing. They have a beta of 1.3, meaning the stock moves 30% more than the S&P 500 in the same direction. So if the S&P 500 goes up by $100, Boeing would go up by $130. If beta is negative, it would move in the opposite direction of the S&P 500. When designing a portfolio of stocks, you don't want everything to move 1-to-1 with the S&P 500, as you want there to be diversification. Thanks for tuning in to the recap of days 1 through 15 of my Dow series. Please check me out on dz.money on Instagram.